The December quarter was an eventful quarter. We had the US election. We also had a lot of data in terms of inflation coming through. The Federal Reserve was cutting rates, but notwithstanding that, we actually saw bond yields rise over the quarter. Nominal bond yields in Australia rose from just under 4% to finish the quarter at just under 4.4%, while inflation-linked real bond yields, as we refer to them, rose from 1.68% to finish the quarter at 2.07%. Now, 2% is historically high in a post-GFC context. That rise in real bond yields, as a valuation input, saw weakness in repricing, and generally it was in line with what you would expect given the magnitude of that softness in the bond yields. Now, with the repricing recalibrating off that historically high real bond yield of 2%, we see many REITs as attractively priced. Moving back to performance, we had strong performance coming through from two of the smaller stocks that we hold in the SGH Property Income Fund, being Aspen Group as well as Peet Limited. While three detractors came from the larger holdings and larger stocks, I should say, or securities, being GPT Group, Dexus Property Group and Stockland. The Property Income Fund is focused on investing in real assets for income. At the moment, the portfolio is trading at around a 15% discount to its net tangible asset backing and around a 20% discount to our internally derived net asset value, which is based on through the cycle capitalisation rates. What I mean by through the cycle capitalisation rates is we assume a more steady capitalisation rate over time so that we don't fall in the trap of seeing stocks being cheap, being at a discount to NTA, when the NTA itself is very elevated, or conversely, we don't be scared to invest in stocks when they're trading above NTA if the NTAs are very, very depressed. So we take a more through the cycle view. That's what I mean by that. The portfolio, what we've been doing in the past years, we've been steadily moving the portfolio to smaller REITs, which is where we see more value. And as I mentioned before, Aspen Group, as well as Peet Limited, are a couple of examples where that's playing out very positively for the portfolio. Our portfolio, that's the SGH Property Income Fund, is well diversified. At the moment, we don't have any individual security over the 10%. Now that contrasts markedly to the AREIT sector, which is very concentrated. In fact, we have one security, being Goodman Group, representing over 40% of the AREIT indice. In terms of what we've been doing with the portfolio, we've been adding to positions in GPT Property Group. We've also been adding to Dexus Industria, and we've introduced Growthpoint Australia into the portfolio. Growthpoint Australia is a group that we've been looking at for some time. It's been attractively priced. What's made us more enthusiastic is a change with the fund manager and how he's pivoting the group. They sold down some industrial assets into a partnership that should drive growth and, importantly, also reduces gearing. In terms of what we've been doing on the selling side or reducing, we've been reducing in Stockland. We like Stockland, it's a high quality group, but the income yield, it's had strong price performance, is not as attractive as it was. In fact, GPT, I mentioned earlier, is a higher income yield now, so we've used some of the proceeds to buy GPT there. We've also been reducing Mirvac Group as well. Mirvac, the yield is lower, and also we're a little bit more cautious on the quality of the income there as well. Finally, we've been reducing our exposure to Charter Hall Retail. The reason why we've been doing that is they've been pursuing a takeover for hotel property investments jointly with Hostplus. We're a bit cautious on that takeover. Reason being is we think that it adds more complexity to Charter Hall Retail for a number of reasons, as well as increasing the gearing of the entity. So we've been reducing our exposure there. The SGH Property Income Fund, as the name would imply, is about investing for income. So we're looking to invest in real assets, delivering reliable, stable cash flow coming primarily from rent. Secondly, we're looking for attractive pricing valuations. And at the moment, the portfolio, as I mentioned earlier, is trying to discount to its net tangible asset backing and our NAVs. So we're seeing good value there. Now this, in terms of the discount to net tangible asset backing, is after many of the REITs have seen their NTAs decline as interest rates were on the ascent, so we're seeing good value there. Finally, we're taking an active approach to building out the portfolio. The portfolio is well diversified. We've been shifting it more into the smaller entities. We're seeing more value. We're very cognizant of risk, and we're looking to build out a portfolio that's going to deliver for the long term. Retail is continuing to just perform along in a very steady fashion, as I mentioned. Office, a bit more nuance. Melbourne office market does have its challenges, but we are seeing an increased momentum in terms of return to office. Still elevated incentives, it's the softest office market. Having said that, Brisbane and Perth office markets are strong. Sydney, we're seeing strong, or I should say green shoots emerging, and we actually saw strong net absorption there quite recently. That's take up of space by tenants. So we're seeing a positive environment there. Industrial, we're seeing a little bit of softness. We're seeing that the rental growth that we saw in the past year or two has really come down, and vacancy rates, whilst being low, are on the ascent, so we're a bit more cautious there. Residential, I could be on this call all day talking about residential, but we all know that Australia has an undersupply of housing, and that supply is really the solution, and that's why we've got to focus on the developers that can deliver affordable product, and the best at doing that is really Stockland Group and Peet Limited, which are in our portfolio.